Hello, and welcome to The Beat. I'm Ben Hunnicky, Head of Investment Management at Morgan Stanley. With me today is Lauren Hochfelder, Co-Chief Executive Officer of Morgan Stanley Real Estate Investing. This week, we're going to dive into the state of the commercial real estate market, explore key themes and trends, and highlight our expectations for 2025. So Lauren, welcome. So it's been a bit of time since COVID. Obviously, what is the current state of the commercial real estate market? What are you seeing in your team?
Yeah, well, look, we're nearly 3 years into a real estate correction, so it's been an interesting 3 years. Values in the U.S. down 25% plus, in many asset classes even more. The same period of time where we've seen equities just rise 60+%. So real estate on a relative basis, we think very well priced. And I think importantly, we're seeing a bottom start to form. So liquidity up, transaction volume up, cost of capital coming down. And we really think 2025, 2026 will see the transition into an upcycle. There are conditions on the ground that we think set us up really well for recovery. Not just interest rate moderation, but importantly, supply, new construction down sharply.
So take me through the investment process. So how does your team go through and in such an idiosyncratic asset class like real estate, identify the sectors, the regions, and the properties themselves that you want to own?
Yeah, it's a great question because people often talk about real estate as though it's one homogeneous asset class, and obviously it's anything but. So, of course, changes in interest rates affect all real estate assets, but changes in behavior, structural shifts in how human beings use real estate create winners and losers. And so we start with what are the durable structural mega trends that are going to help us understand where demand is growing. So we're looking at things like aging demographics, supply chain changes, e-commerce penetration. So look, you and I can sit here and speculate what's going to happen about interest rates, but we can calculate the number of 80-year-olds in this country and what that looks like over the next decade.
You've talked a lot about demographics and the impact on real estate. Maybe just double click on that. How do you think about the shifting demographics? How does that affect demand for real estate over time?
Yeah, so as we age, of course, our real estate needs shift. And so if you look at the US in particular, there are two large age cohorts. It's the millennials who are growing up and growing out, and the boomers who are growing older. And so what we're really seeing essentially is millennials need more space, boomers need more services, more housing with increased healthcare service options. So we've been heavily investing in senior housing. That's been a really attractive space. And that's a direct function of just looking at the number of 80-year-olds. And frankly, the boomer generation, it is big and it is wealthy. Both of those things are good for senior housing demand.
So one other big change that's out there is the recalibration of supply chains, the return of geopolitics. Obviously, that has huge implications on real estate. How does the redesign of the global supply chain impact your thoughts on the real estate opportunity?
Yeah, this is something we've been focused on for quite some time. We think we're at the early innings of a rerouting and rerouting of the global supply chain. So as you referenced, we're doing essentially a U-turn on globalization. And then related, we're seeing an increased frequency and severity of event-driven supply shocks. So COVID was a big one when we couldn't get protective gear or our sneakers, but we're seeing other ones, right? Trade disruptions in the Red Sea, even Baltimore Bridge. So these increased event shocks together with this U-turn on globalization are forcing companies to not put all their eggs in one basket. They're diversifying where they manufacture their goods and how they get those goods to the end consumer. So manufacturing points and trade routes. Both of those things create more demand for industrial real estate and frankly shift where that demand is most pronounced.
So you mentioned at the onset just interest rates. That's kind of a universal impactor of real estate.
Yes.
Can't turn on the TV without speculation about where interest rates are going. In a world of higher for longer, how does that affect your thesis on real estate investing?
Yeah, look, interest rates moderating on some bumpy slope down, but probably staying elevated, as you say. The moderation is good for real estate. But ultimately, we don't expect interest rates to get back down to pre-COVID levels. And that means that unlike the period post the GFC, where a lot of real estate investors made a lot of money on cheap debt and cap rate compression, we think this cycle, the way you generate returns is different. We think this cycle, it's all about cash flow growth, which means owning assets in those sectors that have those mega trends propelling demand. And frankly, owning assets that you can really work. So not necessarily buy and hold, but buy and change.
Oh, Lauren, fantastic. So one last question before we let you go. One book you're reading.
Well, there's only one I'm reading right now. So I am reading Civilization by Neil Ferguson, which, we're talking about geopolitics. He's
Front and
pretty
center in
interesting.
a lot of the dialogue these days.
Absolutely.
That's great. That's great. Thanks, Lauren. We hope today's discussion provided you with a deeper understanding of the commercial real estate market and some of the key themes we're focused on. Thanks for watching, and be sure to follow our page for the latest insights from our investment specialists. Thank you.